As with any investment, real estate's got its good, its bad and its average performing assets. And if you're not careful, you could easily end up with a property investment lemon. The problem is, owning a dud property means you could be losing out money because your holding costs exceed your income, your rent capital growth. Or you could be losing the opportunity cost to make better returns elsewhere. Or the lack of equity and rental growth is going to compromise your ability to keep adding to your portfolio. The best way to uncover an underperforming asset before it eats too far into your bottom line is to annually review your portfolio and ask yourself some hard questions. Firstly, is this property performing like I expected it to? Secondly, is this property outperforming the market? If this property was on the market today, would I buy it again? Ask yourself, is there anything you could do to improve your property so it could generate a more attractive return? And ask, is this property likely to outperform the averages for the next decade or more? Because the answer to these questions will help ensure that you retain a top performing property and that your money works hard for you. The key to this is to analyse your investment goals and determine if your current portfolio has got you on the right path to achieve those goals. So what makes a property underperform? The problem could be market related or related specifically to your property, and it usually falls into one of four categories. Firstly, timing. Buying at the wrong time in the cycle, when values are at or near their peak, could well mean your property may languish for a few years or even fall in value for a while. The other is price. If you paid too much, you may not have any capital growth for a year or two. Location is critical as well. Some suburbs outperform others, and even in better areas, some locations within those suburbs are more desirable and outperform. And the last thing is the property itself. In other words, poor property selection. If you bought the right property at the wrong time or paid too much, you're generally going to find that real estate is very forgiving, and in time your property will start to perform. But if you've bought the wrong property or in the wrong location, sometimes you're better to bite the bullet and sell so you can buy a better performing asset. After all, if a property hasn't performed well for over 3 or 4 years, it's likely to be a dud. So the answer to these questions helps ensure that you only retain top performing properties and your money's working hard. One of the big mistakes I see many investors make is actually not even starting with a strategy for their investments. If you don't have a plan, how do you know what to buy, and how do you know if your properties are performing as expected? The other big mistake they make is not reviewing their portfolio to make sure that they're performing according to that plan. In my opinion, this should be done with the help of somebody who's independent, as many of us just get too emotionally attached to our properties. Then, if you've bought a dud, rather than ignoring it, ask yourself, why isn't this working as I planned? Of course, this assumes that you are following a strategy that works. Remember, many investors fail because they're following a flawed plan. Maybe the answer is as easy as changing to a more proactive property manager, or maybe you could improve in value by doing some renovations, making it more attractive to tenants, upgrading your property could increase your rent. But sometimes it's just simply allowing time to work its magic and waiting for the property cycle to move on. But while property investment is a long-term game, occasionally the right answer is to cut your losses and sell up so you can buy a better property. However, if your property is tenanted, maybe you should consider selling it at or near the end of its term of the lease to widen your appeal to a wide range of owner-occupiers as well as investors. But I bet some of you are thinking, Michael, what if it's the wrong time to sell? Look at it this way. If due to your financial capacity you can only own 5 properties, you should aim to own the best 5 performing assets you possibly can. I know there are many times when the market's flat and you may not be able to get the price you want, but waiting to take action until things pick up again will only see the gap between your underperforming and the better performing investments widen as the market improves. At this point, it's going to be even harder and more expensive for you to buy the sort of property you'd like to own. So essentially, the sooner you can identify and offload an underperforming property, the better. Sure, you may crystallise a loss or pay capital gains tax on the sale as well as selling costs, and then pay stamp duty and acquisition costs on your next purchase. And I understand this means taking 2 steps back to move 3 steps forward, but if you treat your property investments like a business, and that's what all strategic investors do, you'll understand that while it's costly to dispose of a dud property, it's even more expensive to hold on to an underperforming asset. And an example I often use with clients is I say, if you were in business and you had some staff members and the staff members came late to work every day and then they played on Twitter and Facebook during the day and they went off to lunch and came back late and didn't see the customers, the clients, the patients, what would you do? And my clients would normally say to me, well, I'd sack them. And I'd say, well, you probably wouldn't be able to do that straight away. You'd have to do a performance review. And this is what we're doing with your properties. And the performance review suggests that they're not good employees in your multi-million-dollar business. So then, yes, you may have to sack them, but you'd also have to pay a retrenchment fee, a redundancy package. But that's okay because you'd be prepared to pay it for your employees because you know you would have a different employee coming in, working harder for you, making you more money. And it's much the same with properties. So if you want to have somebody independent have a look at your portfolio to see how it's going, why not make an appointment with the team at Metropole to review your portfolio, or if you haven't got an investment portfolio yet and you want to get going, to help you formulate a plan. I look forward to being part of your wealth creation journey.